Thanks for joining in to another one of our Financial Insights videos. My name is Tyler Johnson. I am the owner and lead advisor with StillWater Financial Advisors. And this week, I wanted to address a topic that is coming up more often when I see research or talking to people in the community. And it's the idea of becoming your own bank over time through using and investing into a cash value life insurance policy. This strategy is often referred to with the name infinite banking and is touted to be a strategy used by the high net worth clients or the very affluent in order to have tax free access to money outside of the traditional banking system. The idea is that your cash value allows for tax free borrowing as it grows, and you essentially pay yourself back if or when you're ready. There's an interest rate on it, but again, you're paying yourself back, not a banking or lending institution. If you don't pay back your loan balance by the time that you pass away, then your outstanding balance simply reduces the death benefit that the company would pay to you. So this is an intriguing tool, and it has maybe some interesting use cases. But like most things, there are trade-offs that it's important to understand before getting too excited and jumping into something like this. And it's a trade. These trade-offs you're not going to likely hear from your local insurance agent or even many financial professionals that help sell and facilitate you having these policies. Most important point to know right off the bat is that no insurance company is in the charity business. If they are offering you any product, they have weighed what they need to charge you and others like you to make a profit off of you over time. They do not always get this calculation right, but the companies that you would want to use for something like this that have been around for a long time are pretty good at the number crunching. So if you think you're going to use an insurance vehicle as a wealth building machine, I am guessing that you would be disappointed compared to alternative options done well. The second key thing to note is that agents or advisors that are selling you a policy often get paid handsomely when the deal is made. This doesn't necessarily make it wrong or bad. You just want to be aware that this conflict of interest exists and make sure that it's being done and looked at through purely your best interest compared to all alternatives. So, education wise, cash value life insurance is cheaper at a younger age when you are at your healthiest and you're less likely to pass away soon. You can lock in a lower fixed cost policy when you are younger. Part of what you pay for each month goes towards the expenses that the insurance company has to keep the policy for you, and the other part goes towards your cash value over time. The insurance company is setting the cost monthly or annually at an amount where they expect your cash value later in life to make up for the much higher cost of insurance as you age. This is why people can see their cash value balances decline at a certain point later in life, even without making withdrawals. However, if your cash value does run out or deplete at any point due to withdrawals or other factors, you will likely have to make up the difference or run the risk of letting your policy lapse or accepting a much lesser death benefit than what you paid into over the years. You can pay more into your policy than just what the insurance company has suggested. This is called overfunding a policy, and it allows you to build your cash value more quickly. However, there are rules within the first 7 years that you must follow to avoid your policy becoming something called a MEC, which is a modified endowment contract, where it is essentially treated by law as an investment vehicle and you lose access to the favorable lifetime withdrawal benefits. Once a policy is a MEC, it is always a MEC. So it is something that you want to make sure you know and understand with the person selling you the policy. You also want to note how interest is being earned on your cash value policy. It could be a fixed rate, which is often called whole life. This is almost always unfavorable as an accumulation tool over a long period of time. It could also be linked to an index's performance, something called an index universal life, IUL, or it may be something where you can even choose your investment mix and determine the risk that you want to take with the cash value being invested. That is called a variable universal life, or a VUL. If you are only making the stated monthly payments into your policy, it takes time to build significant cash value that you can actually borrow against. There could also be surrender charges to access your cash value in the early years of your policy. So you do want to treat it as a long term investment or insurance vehicle. And you also want to understand that it's really designed to be a risk mitigation vehicle and not a highly beneficial investment vehicle. If using this as a strategy, you want to make sure that you, again, have a long time horizon, know how your cash value will grow as well as when it won't, because there are cases when it could go down or at least not go up, depending on the type of policy you have. And you want to weigh the cost of putting money into this policy versus other types of investments where you could place your dollars. There are all kinds of reasons a cash value policy could make sense for your situation, but there are probably many more reasons that it may not. And you should have a trusted professional review your unique needs and plans and help you weigh your different options. If it is used for clients that I work with, it is usually a small piece of the overall puzzle to create some diversification. Don't buy into eager sales pitches without proper vetting and analysis. To talk more about this around your unique situation or to talk about specifics. You can always reach out with the details, the contact details at the end of this video. And also, don't forget to subscribe to our channel to stay up to date on helpful insights like this and others. We look forward to seeing you next time, and have a great week.